Good evening. Thank you for joining us. My name is Sheena Pasco. I'm the Director of Marketing for the Startup Path. Welcome to our free monthly webinar. Tonight's topic is financial forecasting, and we will show you how to create a sales forecast. But before I introduce our guest speaker, I would like to tell you about the resources we've created for you here at the Startup Path. Step 1 is our webinar series. You can see the current webinars that we have here, and also you can locate our webinar archives in case you've missed a presentation or would like to go back and see what we've talked about before. Step 2 provides you with assessment tools to help you find the right fit between who you are and the wide variety of businesses that exist. Finding the right fit between your personality and the type of business you start is crucial to your success. Step 3 enables you to learn a business from a mentor, someone who has actually done it. We currently have 27 mentors in a wide range of industries, all online, who share their advice and reveal their secrets to success. Steps 4 through 6 contain 21 online lessons that cover everything you need to know about starting, growing, and running your business. The featured speaker in today's webinar is the Startup Path's own resident expert in entrepreneurship, Dr. Tom Denning. Dr. Denning is the director of the Center for Entrepreneurship at the University of Colorado in Colorado Springs. He has been an entrepreneur since 1984 and has started and ran 7 businesses in his career, also written 12 books, consulted with startups in a wide range of industries. Please be aware you may see the waiting room screen come up as I pass the presentation to Tom.
Thank you, Sheena, and welcome everybody. Great to have you here tonight. Today we're going to be talking about financial forecasting and really focusing on the first statement, the foundational statement of financial forecasting, and that's the sales forecast. Every business needs to get some idea of how much they're going to be able to sell, and it has to be realistic about it, because in entrepreneurship, of course, the essence of entrepreneurship, the essence of business is to create value for customers. And of course, the value that you create is something that you have to find a price point for. And that's really a discovery process. When you think about setting prices, maybe you walk into a store and you see all the prices on all the items that are available there, and you think, boy, that's kind of fixed, you know, and their prices are, and it's what we have to pay and everything. But when you think about the companies or the entrepreneurs behind those items, it is a discovery process. So your sales forecast is, as all of your financial statements when you're doing a forecast, are fraught with all kinds of uncertainties. And what we're going to do tonight is try to eliminate some of those uncertainties by giving you some idea of how to create these various financial statements tonight, focusing only on the sales forecast. In your financial planning for your venture, obviously when you begin, you're going to have all these startup expenses, so don't discount the importance of all the different things that you're going to need just to get your business to a point where you can look as though you have something substantial enough to actually serve customers. And entrepreneurs are very creative about how they manage their startup expenses and look like they're a bigger company than they actually are. And so this is a very creative process, but at the same time, you know, hoodwinking customers or you know, representing something that just isn't so is probably just going to lead to all kinds of difficulties for you. But, you know, all the things that you need to do to get your business to a point where you're ready to start selling are part of what we call the startup expenses. And startup expenses are typically managed by seed capital. That means you need a little bit of money just to get the business to a point where you can actually start selling. And seed capital, you know where that comes from. Typically it comes from the entrepreneur, him or herself, the friends and family and fools, the FF&F that we've talked about so many times here at the Startup Path, is where the money comes from for the startup expenses. Over the course of time, and certainly at the Startup Path, we talk about 4 different what we call pro forma financial statements: the sales forecast, the profit and loss or the income statement, the cash flow statement, and the balance sheet. Each one of these tells the entrepreneur something different about their business. And if you are going to be a serious entrepreneur and think that you're going to be in business for quite some time and maybe even might raise some capital or go to a bank to get a loan, you are going to need at least 3 years of forecast statements. And that applies whether or not you're just starting out or whether you've been in business for a long time. Every bank, every investor is going to require that you forecast into the future how the business is going to look, let's say 12, 24, or 36 months from now. So there's no escaping it, no matter where you are in your overall business development. So your financial statements and the business plan, they normally cover at least 3 years. So that's 36 months. So if you can imagine, you've got a forecast where your business is going to be and how much you're going to be selling 36 months from now. Most of you probably don't even know where you're going to be 36 months from now. And yet at the same time, this is an absolute requirement of raising capital or getting a loan or even putting together a business plan that you can rely upon as sort of a roadmap for your own future. 3 years of financial forecasting. Tonight we're going to go into the sales forecast. We're only going to look at year number 1. In the courses that are available to you at the Startup Path, we do go through the entire 3 years. You know, and very, very important to recognize that all of the financial forecasting you do is based on a set of assumptions and formulas. The assumptions are critical, and you are going to be challenged on your assumptions. So if you assume that your price point is going to be X, people are going to say, why is it X and not Y? And how is it that you're going to be able to sell at that price point as opposed to all the other competitors out there who are selling at W, right, or whatever it might be. So don't think that you can put together a spreadsheet, your sales forecast, and not have to defend it if you are going to be seeking some capital either from a banker or from an investor. We're going to be looking at an Excel spreadsheet, and for those of you who are participating in our webinar tonight, you're going to get a free template from us, a sales forecast free template. Only for those who are participating tonight, the actual live broadcast of this webinar. Those of you who come in and see this in the archive are going to have to go and take the course to be able to get the entire spreadsheet. So what does a financial forecast do? Well, it provides you some visibility of your future. It gives you some idea when your cash is going to be at break even, and believe me, you're going to really want to know when that is. And you know, less important, but also you know, something that you're going to want to know is the profit break even point. And so you say, why is the cash break-even point more important than profit? Believe me, when you have to pay bills as an entrepreneur and make your payroll and everything, your cash break-even point is far more important than your profit break-even point. So your assumptions are going to be incredibly important here. So whether it's investors or loan officers, they're going to be looking for the clarity of the expression of the assumptions that are underlying your projections. They're going to be looking for, are you consistent with knowledge of commercial practices? And that's to say that, you know, if you're projecting that you're going to grow, you know, 100%, 200% a month, and typically companies that are entering this industry only grow at 5% a month, they're going to wonder, you know, whether or not you're just pulling numbers out of the air to feed a fantasy or something. So you really have to have some knowledge of commercial practices and make sure that your numbers are fairly consistent with that, and to the extent that they are not consistent with industry or commercial practices, then in fact you have a very good explanation for why that is so. You want to have internal consistency of your numbers. That means your numbers have to hang together. So if you see tremendous growth during a particular quarter, perhaps you know, let's say 24 months from now, well, there's probably going to be a corresponding investment in marketing expense that makes that happen. So those are the kind of things that savvy loan officers and investors look for, whether or not anybody that's projecting into the future has some type of consistency in these numbers. If you're going to be scaling up the business, well, obviously your expenses are going to be scaling up at the same time. And you want to be comprehensive. So you want to make sure that you have all of the potential revenue streams accounted for, you have all the different cost items accounted for in your basic assumptions that you make. So here's some, you know, just some examples of some basic assumptions. How many units are you going to sell per month? What is your price per unit of sale? What are your costs of goods sold, for example? And, you know, and later on in the income statement, we'll be looking at things like travel and entertainment costs and other things that have to be accounted for, and that you need to have some assumptions that seem to be realistic with the sales forecast. So what are investors looking for when they're thinking about potentially perhaps investing in your company? Well, they're looking for a very large opportunity. They want to know whether you can become first, second, or third in your marketplace. They're looking for market share, profitability, and your ability to be long-term competitive. This says a 10x return on investment, but that's mostly venture capital. Other investors, angel investors, for example, are only looking for like 3 to 4x, and bankers certainly quite a bit less than that. how much total financing will you need? And that doesn't mean just in this round of financing, but into the future as well. If I'm investing now and getting an equity stake in your company, if you need future rounds of financing, that means I'll be diluted in the future, and I want to know what your projections are for those future rounds of financing. How probable is liquidity and how long it's going to get there? Liquidity means when are you going to exit? Are you going to be able to sell the company? Are you going to IPO? And how long is it going to take for us to get there? Because holding on to the stock in your company doesn't do me any good unless I can forecast that at some future point we're going to be able to turn that stock into cash, and that typically happens only at what is called a liquidity or an exit event, which is an acquisition, an outright sale of the company to maybe another entrepreneur, or something like an IPO or a merger. When does the break-even point occur, and what are the and what kind of revenue numbers you need to reach in order to achieve those break-even points? When does profitability occur? And then, of course, what are your milestones and fundraising events? So milestones are very important to entrepreneurs, investors, and so on. And these are sort of ways of holding you accountable as the leader of the company, that in fact you are driving and executing. You're driving towards a business plan. You're executing on the business plan. And these are things like, the beta launch, maybe a memorandum of understanding or a letter of intent from key clients, an invoice, a prototype is done, or a patent filing. All are examples of key milestone events that occur in a venture's lifetime. So hidden in the financials are some things like, does the business model scale well? So can you ramp up either rapidly or deliberately and slowly to meet scaling demand? And that means that you have to have a supply chain in place if you're doing some product manufacturing, or that you have to have enough personnel to fill the pipeline if in fact you are doing something like a consulting business where billable hours are limited by your by the number of hours that you need to sleep each night, and you might need to hire additional people in order to fill that pipeline with increasing demand. Are your sales projections realistic? Are you in line with standard industry growth ratios and so on? Is the total amount of financing realistic? Can you achieve your goals with the kinds of capital that you're seeking, for example? And how have the costs of growth been factored in? So you're going to think about the amount of marketing per sales, the amount of legal expenses for all the intellectual property that you're going to try to put together, the number of employees that you have and the burden that you have to pay on those employees. And of course, burden is things like employment insurance and benefits and things like that. And then, is your executive management team adequate to meet the challenges that you're facing? As the entrepreneur in charge of a venture, it may be extraordinarily difficult as this thing begins to scale for you to manage all the things at the same time: the supply chain, the marketing, the sales, even the HR inside your own company. You might need to hire additional executive management. So our sales forecast is a revenue estimate, and I really look at it as the foundation of your pro forma statements. The sales forecast, typically when I'm doing a new set of pro formas for a venture, I probably labor over that more than anything else, because you really have to make sure that you're being realistic. You can't be too pie in the sky, and indicate that your numbers are going to be wildly over-optimistic, and you certainly don't want to be overly pessimistic. Nobody's going to invest if you, it seems as though you just simply can't make it, right? And it's going to take 3 years before you get to break even. Nobody's going to touch that. And if you, but at the same time, you've got to be so realistic that you either talk yourself into doing this business or you talk yourself out of it. Either way, it's a good thing. If you talk yourself out of it, it probably wasn't going to be successful anyway. If you talk yourself into it, well, now you've committed, and let's see where it goes. You have to estimate your price and volume of sales, that's always sort of numbers that you have to be very careful about how you produce them. I mean, price points are very much variable, and certainly your prices can vary within your own sales forecast. You might start with a sort of a discount price upon entering the market, and then raise your prices later on, and that's fine, but you have to be able to indicate that in your sales forecast, because your investors are going to want to know how it is that your future customers are going to be able to accept a higher price point than your early adopters, if you will. You always have to think in terms of realistic sales volume. How many units are you really going to be able to sell, right? And just because you have a website and that people can come to your website, for free, doesn't mean that they're going to buy your stuff. So somehow or other, you've got to understand your customer enough to know what are those decision points and how long does it take to get them to make a decision about buying your stuff. And of course, we call that the sales cycle. No matter what you're selling, there's a cycle that's involved with the sort of the first awareness of the fact that you have a product. There's some deliberation and maybe even some comparisons that the customers will do with various other products that are substitutes for yours. And then there's going to finally be a decision at some future date that says, I'm ready to go with you. Here's the credit card. I'm going to make a purchase. And how long is that? It depends upon your business. So let's just say you're going to start a restaurant. Now, how many seats do you have in the restaurant, right? How many meals per day are you going to serve? What are the price points of those meals? What's the average ticket price? How many turnovers are you going to have for each table during the day? There's all kinds of metrics that each industry will have that you can certainly do some research on to make sure that you're covering the appropriate metrics and have a pretty good realistic forecast of what's going to happen in your venture. So here's some key questions that you need to answer. When will you begin to generate revenue? So let's just say you're launching your venture. It's startup day. You open the doors, you turn on all the computers, the phone is set up, and now you're waiting for your first customer. How long is that going to take before you get out there, all your different marketing campaigns that you have underway, whether it's direct mail, whether it's telephone, telemarketing, whether it's email marketing, and so how long is that going to take before you generate your revenue, right? And of course, that has nothing to say about how rapidly the revenue will grow. If your first revenue comes from your mom and dad and your brother and sister and so on, well, that's not really an indication of what your target market is doing, right? Your target market is going to take its own sweet time and it's going to act in its own deliberate way to make a decision about buying the stuff that you're offering. So, so the span of time that your forecast needs to be made, we're going to go and say 3 years. That's very general, very common in almost any industry. 5 years and 10 years is almost unheard of. But there are some VCs out there, for example, that are looking at companies like Facebook and so on that are really looking for 5-year forecasts more than just a simple 3-year forecast. So what is our forecasting interval? We're going to talk about monthly. All right. When you actually go into business and you start taking doing your historical accounting, you're going to do it weekly, monthly. Actually, you're going to do it daily, weekly, monthly, annually. And for our forecast purposes, typically what I've seen is we only do it for the monthly, and then of course we do the annual summation as well. So I'm going to change now to a spreadsheet. We're actually going to get into a sales forecast. So this is kind of what a sales forecast looks like. I'm going to try to expand this just a little bit so that it. All right. So we got a little network issue here tonight. That's well, that's technology. So let's go back to where we started. So this is a typical sales forecast, and as you can see, I've got in the left-hand column here different products listed. So product A, product B, product C, and I'm talking about the number of units of each product that I'm going to sell. Now, in these various cells, you would actually enter your own products. So if I'm a service company, let's say I'm a consulting companies typically bill by the hours. So I might say Tom's billable hours, right? Did I spell that right? Yeah. So Tom's billable hours for month 1 would be 50, right? So if I have a service business, that might be the way that we actually bill. We might do Tom's, instead of billable hours, we might say Tom's projects. Right? So we might have a business that goes by projects. I'm probably not going to do 50 per month, depending on what I'm doing. I mean, maybe I'm maybe I produce PowerPoint slides for people or something, and I do 50 per month, right? So whatever your business is, you have to enter that in there. If I say it's a product, I might say, hey, I'm selling Beanie Babies. So Beanie Baby, I don't know what the names are. I don't even know why I thought of Beanie Babies, but Beanie Baby. Cedric, right? So how many Cedrics are we going to sell in month 1? 50, okay? So that's what that refers to. So I'm going to leave this as just product A unit sales, And you need to know that this is for you to fill your own units into this cell right here. And then in the revenue line, product B unit sales, product C unit sales, you could go all the way to product Z, depending on how many different products and services you intend to offer through your business. All right? So now, you'll see below that, we have a concept called ramp rate, which I will get to in a moment, and we have a concept called price. So obviously here, the product A price refers to what I intend to sell product A per unit for. So here I'm saying I'm going to sell product A for 10 bucks a unit. And what I've done, if I sell 50 units at 10 bucks a unit, well, guess what? The revenue is $500. And of course, that's formula driven. Okay? So now you say, what's my product B price? $29.95. Product C price is $12. Now I have these prices according to this little spreadsheet that we have here. They don't vary for the entire year. You can see that during the entire 12 months of this sales forecast, these prices just stay the same, right? And that's a very simple way of looking at it, because it's quite possible that I might have a discount price on getting started. And I might say, look, we're going to have a 50% discount during the first 4 months so that this now becomes $5 rather than $10, right? Then you just fill that in. And of course, the numbers up here adjust accordingly, right? And so what you do now by having this being formula driven is you're able to play around with these numbers a little bit to see what you end up with. And if I have that 50% discount on product A during the first year, you can see that I still generate $410,000 or $409,000 of total revenue based upon the other assumptions that I put into here. Now let's take a look at these assumptions, okay? Very important now to really capture what I'm going to be talking about next, okay? So I start month one and I say, look, I'm going to sell 50 units of product A, and I'm going to sell them at $5 a piece, okay? So now I have to think, okay, how quickly is that going to grow? If I sell 50 during month one, how many can I sell during month two? And that's called your ramp rate. That means how quickly are your sales going to ramp up and change from month to month. And as you can see, it's a percentage of the prior month's sales. So I'm saying that from month one to month two, I'm only going to increase my sales by 0.5%. And then, because now I'm starting to get some real traction in the marketplace, and because my products are somewhat seasonal, suddenly during month three, I'm going to have a 100% spike in my sales from the prior month. Okay? So this means the amount of sales increase for the third month over the second month. I hope you get that. Let me say it one more time. This number here indicates the amount of sales increase in month three over month two. And this is formula driven as well. So this formula simply says, I'll take my 50 from month two, which of course is about like 50.5 because of this little number here. Multiply it times 100% or times 2, right? And that's how I get my 101 units of sale for month three. So this is a variable. I can play with this depending on what I think I can actually achieve in the marketplace based upon my research, based upon my customer knowledge. I've gone out and talked to customers. How many of these will you buy? Will you buy multiple units of these things, and so on? And of course, I also look at the seasonality. So for me, so this doesn't necessarily mean January. This could be July, right? It doesn't matter. Month one is month one. It doesn't have to be January. It can be, whatever month. And I'm saying that I'm going to launch this business. Let's say I launch it in April, and I happen to have a business that sells more in the summer months. This is April, May, June, July, August, September. And as you can see, I grow by 100% each of those months. And then, oh, here comes winter again, and my sales taper off. Okay? So that's how you manage ramp rate. That's how you manage your monthly changes in unit sales, by adjusting this variable right here in the ramp rate line. And each product has its own ramp rate. And if you also notice now, I'm saying, look, I don't start selling product B until month 4, right? So I have 0, 0, 0, 0, and then in month 4, I estimate that by month 4, my brand is going to be well enough known that I'll start selling 100 units of product B at $29.95. Okay? And then I have a ramp rate that applies to that number for the rest of the year. Product C, I don't start selling until month 8. And then I'm selling 1,000 units. It's like, that's pretty good. Okay? And it goes up. I've got a tiny little ramp right there, you know, that starts applying. Actually, this should be zeroed out because it doesn't matter on 0. And then each product has its own price, which is a variable. I can play with these prices. I can adjust them for seasonality. I can do whatever I want. These numbers are the revenue numbers. So I'm going to sell $250 of product A in month 1, $251 in month 2, $503 in month 3, and guess what? Lo and behold, in month 4, I'm selling product A and product B and making $5,000 a month in total revenue. Okay? And you just go on through the entire rest of the year, and as you can see by month 8, now I've got revenue in 3 different categories: product A, product B, product C, and I'm making almost $40,000 a month. You just do a summation at the end of the year, and as you can see, this little business here with these various assumptions drives about $409,000 in total sales. And over here, these are summation lines, so I can see I'm selling this number here is driven by a sale of 26,670 units of product A, 2,788 units of product B, and 5,000 units of product C. So you can kind of get a sense of how active you need to be in order to generate these kinds of numbers. And over here I've got some percentage numbers, so I can see that product A is about 65% of my sales in year 1. Product B is about 21% of my sales, and product C is about 15% of my sales. So this helps you understand what really the drivers of your business are. And you know, if product A is continuing to increase in the percentage of your overall revenue, you very well may want to begin to focus more and more on driving the growth via product A. So these kinds of numbers can help you over time. So what you need to do then is download this template, which will be made available to you after tonight. Put in your unit sales over here, whatever they are, whatever your product is, list them out over here, and then have a separate revenue line for each of the different units of sale that you have. And believe me, it's difficult to do because sometimes, you know, let's take McDonald's for example, right? McDonald's sells Big Macs, and Big Macs would be a unit of sale. So I like Big Macs, right? So Big Mac. How many are we going to sell, right? Then, of course, it's also got in product B, it's got a Big Mac value meal, right? So that's a separate unit because it has a different price point and appeals to a different customer. So make sure that you're not just thinking about your SKUs or your stock keeping units, but how you might be bundling them as well to sell them as, you know, multiple units in a single set. Or, you know, for example, if you're selling software, a lot of companies will bundle a maintenance package with the software or an upgrade kind of a license with the software so that you can come back to it time and time again. Come back to your same customer over and over again. Well, okay. So this is product A. Okay, so I hope that helps you. I hope that you understand that it's very important that you get your assumptions right. Now, I will tell you as well that it's incredibly important when you're doing your sales forecast and you're making this assumption, because this is not your very first number that you enter on each unit sales. You have to drive that yourself. There's no formula that drives that first number. This number is formula driven, this one's formula driven, and this is the formula down here, the ramp rate. So when you put in a ramp rate, you've got to be able to justify to somebody why it is that you think you're going to be able to grow 100% in these months. If you start with 50 units of sale in month 1, you've got to be able to justify to somebody why you think you can hit that number in month 1 and what you're going to do about it if you don't, right? What's happening in your environment that has led you not to hit that number? So you may want to write down on a separate sheet of paper the assumptions that you're using to drive these numbers and to drive these numbers that are part of your formulas so that you don't forget later on. This statement right here, the sales forecast, eventually drives to your income statement. And as you can see here, the total revenue line of your income statement is completely correspondent to the bottom line of your sales forecast. So this is your revenue right here. This is all your revenue that you're going to drive. And you have to be able to justify this. So you play with these numbers, and if you build your formulas right, and as you can see, there's no errors in the formula in this package. If you build your formulas right, you'll be able to adjust your numbers and to make sure that you are getting closer and closer to a realistic estimate of how your business is actually going to perform. It's incredibly important to do. So I'm going to basically stop here. I hope that you've enjoyed listening to this sales forecast presentation tonight. I'm going to turn you back now to Sheena, and she's going to close this presentation with a special offer. Thank you very much for attending.
Thanks, Tom. Wow, that was a lot of information in a short webinar. However, we do have a lesson on financial forecasting. It's split into 2 parts. It's located in step 4. Both of these financial forecasting lessons include all the templates you would need to create all your financial forecasting, do all your financial forecasting, not just the sales. And in fact, we do have a discount for you this evening for attending this webinar and viewing Creating Sales Forecast. What you do is you take the coupon code at the very top of the screen there. You'll see it MM2408V, and you put it down at the bottom where the discount code is, and that's for 25% off of step 4 or anything you decide to purchase on the startup path. We do have a money-back guarantee if you're not satisfied. All of our contact information is on our website. We thank you so much for joining us tonight. We look forward to hearing about the business you've started. You can also connect with us on Facebook, Twitter, and LinkedIn, and look for updates to Dr. Denning's blog on our website. Thank you for joining us this evening, and please feel free to contact us with any questions or concerns you have. Thank you so much.